Friday, June 16th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at the Bank of Japan. They're digging deeper and deeper. They're destroying the currency. They've kept rates negative despite prices rising at over 3%. And it could probably be even more because governments always tinker with the price statistics. So we're going to look at that today. Before I start, just like to say, yeah, I'm coming down with some kind of cold. That's why my voice is gone a bit funny. I apologize for that. And yeah, I'd like to also look at some of the headlines before we go into Japan to see what's going on. I see here that Wall Street Bank job cuts set to surpass 11,000 as CEOs unwind hiring binge. Executives try to reverse pandemic recruitment spree that propelled headcounts to record high. So it seems like the pandemic or the lockdowns, more the lockdowns that they instituted upon us, the general public, had a lot of really disruptive effects. And this is one of them. Here in the UK, we were locked down for 240 days. And we're hearing now stories that the government here in the UK, they didn't social distance, they didn't wear a mask because they knew it was all baloney. And we also hearing that Boris Johnson lied to Parliament. So I think his career is over as a politician. It's not surprising. He lied to Parliament. Anyway, another thing I wanted to talk about is jobless claims in the US. It came out over 260,000 yesterday. And if you look at the chart of jobless claims going back, let's say to 2015, 2014, the last time it was above 260 was around 2017, and I'm not looking at the period during the lockdown because it was an artificial spike, right? So recently we've been, I think last year we went below 200 and now it's picking up. So I think that's a bad sign for the US economy that jobless claims are making like 6-year highs. If you, of course, take out the lockdown period, because it's disrupted everything, just like it's disrupted hiring on Wall Street. The other news is related to the UK. It came out yesterday, 2 of UK's biggest lenders to raise mortgage rates. Pressure mounts on governments struggling to contain cost of living crisis as NatWest and Nationwide push up cost of borrowing. And the forecast for a lot of people in the mainstream in the mortgage space in the city of London is that rates are going to peak around 5.5, maybe 6. But I'm afraid it could be a lot higher unless the Bank of England wants to let inflation rip. Well, they've already let it rip. But one thing that caught my attention in this article is that there's a lot more deals that were fixed that are coming due for renewal by the end of this year. I had read earlier that it was like 650,000 deals from the end of June to the end of the year. But according to Marcus Brooks, Chief Investment Officer at Quilter Investors, he said that he predicted 1.4 million fixed rate deals are expected to come to an end this year. So maybe he was counting prior to now, or maybe he's counting from now. And if he's counting from now, it means that it's double of what other people thought a week or two ago. I'm not too sure, but they even talk about a UK debt time bomb and or mortgage bomb. And I even have a playlist, a UK debt time bomb. So there you go. It's becoming mainstream. Some of you say, well, nothing ever happens, but it is happening. It is happening. It's just that things are gradual because the central bank and the politicians are trying to keep it going. And that's what it's all about. Back to Japan. So I have playlists about Japan, about the yen carry trade. I recommend you watch that. It's very important, the yen carry trade. Basically, to put it in a nutshell, it helps the rest of the world borrow and spend and invest. And why? Well, because the Japanese, they've kept rates low artificially at negative. They've kept doing QE, and that keeps the yen low, keeps the yen weak, and it allows people to borrow in yen, which is selling the yen and getting paid for it, minus 0.1 the rate right now. And then they take, let's say, the dollars or the pounds or the euros, and they buy higher yielding assets, and that's the yen carry trade. And yeah, it's like Japan is holding the world on its shoulders, and they're continuing to do that. And there's news today here. Bank of Japan maintains rates policy despite price pressures. So despite the fact that food prices are going up quite a lot over there, despite the fact that CPI is at 3.5%, which is probably more like 5%, because we know that how governments tinker with the data. They've kept rates at minus 0.1, and they're still pegging the 10-year bond JGB below 0.5. I think it's around 0.41. That market has gone off kind of the headlines right now. It's interesting to keep an eye on it. And it's not surprising then that if you look here at data from yardeni.com, and I'm going to put a link to this below in the description, they track central banks' balance sheets. You can see that the BOJ, they hold more than almost 130% of GDP in assets. And they've started to do QE again, of course. They had to last year because the 10-year JGB yield was breaking through that 0.5%. So also wanted to show you something more important. The price of gold in yen. Yes, this is the real barometer or indicator that the yen is doomed, in my opinion. It's probably going to be one of the first major fiat currencies to really get hammered. Here we are. We're at 276,338 as I speak. And approaching the all-time high, as you can see, which means the yen is continuing to drop against gold. And they're concerned about deflation. No, they're concerned about they have to keep inflating. They've created such a huge debt bubble that they can't stop. And I'm afraid it's going to be the same for the US, for Europe, for the UK in the coming years. We're going to go down the Japanese way, but I think it's going to be a lot more turbulent in these countries than in Japan, because Japan still has a big pool of savings. So it's not going to be as simple. And I think the central banks eventually are going to, the non-JGB central banks, they're going to start QE again. And if you look at the world debt clocks, and you can get that from going to the US debt clock, you can see that the Japanese public debt to GDP is just under 300% here, 299.85. So this policy of keeping the yen weak, of keeping the base rate negative still, minus 0.1, all it does is trash the currency, but at the same time, it makes JGB, the debt that the Japanese are carrying, become worth less. So that's how they default, governments and central banks. They do it through inflating the currency. Yeah, that's what they're doing, basically inflating the currency. Inflation is not the CPI. CPI is the consequence of inflation, and we can see in Japan that it's rising. I mean, this excuse of deflation in Japan is really not a good one, but people still seem to buy it. So there you go. Interesting times. We're going to look at the markets now. And one thing I'd say about gold and silver in US dollars, of course, is that yesterday I saw that gold got hammered down to 1924. And I was expecting maybe to see that recently, because gold was under pressure. And why that 1920 area? Well, because if you go back to 2011, the high was right around there, 1921. And some of you might say, well, it's been wasted 12 years. Maybe, but in other currencies, gold has done its job. There's no way around the debt unless they're going to default on all the debt that's coming in the US. We're looking at 50, 52, maybe even more trillion by 2033. It's going to be impossible for the general public on its own to finance all of that debt. Foreigners, of course, are moving away from the dollar. The BRICS nations and the global south, they're diversifying. That's going to come out of the demand for treasuries. So yeah, I would say to my viewers in the US, or those viewers who think in dollars, to be patient. And for viewers elsewhere, I think gold is already doing a very good job. And even going back to 2000, Incrementum keeps a tab of gold performance in all major currencies. And in US dollars, it's gone up by 9% every year in this century. So that's how we have to look at it, in my opinion. And at the bigger picture. So yeah, so what I'm trying to say is we hit that high from 2011 yesterday. Are we out of the woods yet? I don't know. It could go back down there. It could break through it. But I think it's a very strong support. And I know we've been like at 1600 last year. So some people might argue that we could go there. But I find it unlikely. And it doesn't really matter, in my opinion. But for traders, it's a different thing. If you're thinking longer term, gold and silver are, in my opinion, the best way to preserve your savings. It's not investment, of course. That's a different thing. And I think silver will outperform eventually as well, outperform gold. So with that, let's quickly look at the markets. It's just before 8 a.m. London time. So we got spot gold at 1962. It's up about $4. High's been 63, low's been 54. Silver's trading around $24, is up 10 cents. High's been 02 and the low's been 68. Stock market, of course, has been very strong. The Nasdaq, S&P. I recommend you watch an interview I did with Tavi Costa, where he talks about his view on all asset classes. I'm going to put it up in the cards. I posted it yesterday on the channel if you haven't watched it yet. So right now, the Dow futures down 14, Nasdaq down 17, S&P down 3. So not much happening there. We've got the dollar very weak because versus the other fiat currencies that aren't that great either. It's all relative, of course. The pound is pretty strong, or is it the dollar that's weak? We're at 128, up 0.2. The euro is almost back up to 110. We're at 109.50. And the dollar, of course, is rising, though, versus the yen. It's up 0.5%. It's almost at 141. The dollar's down a little bit versus the yuan at 711.50. Aussie dollar, that's very strong as well. We're at 68.90. It's up 0.1%. Dollars unchanged versus the Canadian dollar, 132.23. And the Kiwi dollar is up about 0.2 at 62.34. Let's check the general commodities. WTI crude is up slightly at 70.90. Brent is up 0.2 at 75.80. High-grade copper is up 1/3% at 391. And we've got platinum up $5, trading just below 1,000. Before we look at the bond markets, I just wanted to show you this chart here that Tavi Costa published on social media. So this agricultural commodity prices are sharply moving higher again, suggesting that food prices are poised to follow suit. Not that they haven't been rising here in the UK already. So it says agricultural commodities versus food prices. So the blue line is the UN Food and Agriculture World Food Price Index. And the other one is an ETF on agricultural commodities, the DBA ETF. So you see that one's got to correct here. Either food prices go up or the commodity prices go down. We'll have to see. So I thought that was interesting and I showed that to you. So let's look at the bond markets before we sign off. The US 2-year yield is at 470. That's up 6 basis points. The 10-year is at 375. That's up about 3 basis points. I think the key level there in the 10-year is around 380, 385. That seems to have been the top recently. Let's check the UK yields, which have been rising quite fast. They kind of moderated right now. I think the Bank of England is probably doing a lot of management of price here through its agent banks. But right now, the 2-year is approaching 5% with 497. That's up another 7 basis points. Yeah, and that's the one we need to keep an eye on because that's going to affect those mortgage rates we spoke about earlier. So with that, I'm going to wish you all a very good day and a very good weekend. Take care. Bye.